Greener Media's Mining Weekly is interviewing Stefan Rigny, the executive chairperson of Kanga Potash, which has received its license to mine and produce potash in Africa's Republic of Congo. Kanga now has all the necessary regulatory consents as it enters the pre-construction development phase. Stefan, if I can kick off with this question, what are Kanga's plans with its 12 billion ton potash resource?
We have selected 600,000 tons as our primary module for our first phase production. From there, we will expand to become what I believe is going to be one of the largest producers of MOP, certainly in Africa, because it will perhaps be the first. There are other projects on the go, and certainly one of the largest in the Southern Hemisphere. The resource is sufficient to host easily more than 2 million tons of production per annum of MOP. However, we want to start with what we believe is the most optimal size.
When are contractors likely to be appointed to build the project?
So during our study phase, we conducted a call for tender by consulting large international EPC contractors. We received a number of interested offers, and we retained 3 groups as part of a shortlist. And so we believe that we will be narrowing down that shortlist to a chosen EPC contractor. And from there, probably in this next phase of work, we will be in a position to announce who is our preferred bidder.
And where does the project stand on the cost curve?
So the project is very interesting in that it is a unique combination of geology and geography. Specifically on the geology side, we have managed to discover the largest ever drilled carnallite seams in the world. Now, tapping into carnallite for production of MOP, you use a technology which is called solution mining. And depending on the thickness of the seams, there's direct correlation of how many wells you're going to have to drill with the thickness of the seams. Given the super thick seams that we've seen, we need to drill fewer wells than one would in traditional solution mining operations. And that has a dramatic impact on the OPEX of our project. From a geography point of view, we are literally on the coast. Most projects that you find elsewhere have hundreds, if not thousands of kilometers from mine site to port. In this instance, we're literally on the coast, which means that our mine gate cost is pretty much our FOB cost. And we are there straight line shipping into one of the world's largest markets, and we're perfectly positioned to service the African market. So we are at the lowest point on the cost curve because of this unique advantage of combining geography and geology.
And how is this project being funded?
So up to now, we're a private company, and we teamed up with 2 investment funds. So all of the work has been privately funded up to now. We've spent some $40 million to get to where we are. And going forward, obviously, we have to spend more money to implement the project. We have retained Natexis as our financial advisors, and they have a vast experience in terms of structuring project finance. The project lends itself very nicely to a project finance. So we're looking at gearing the project probably on a 60-40 structure, which is 60% debt, 40% equity. This obviously may change depending on the various types of equities, quasi-equity, mezzanine debt. But certainly from a debt component, there is a significant amount of appetite, and this would be DFI, ECA, and private debt providers. And we would be seeking support from the EPC contractors. One of the requirements when we submitted a call for tenders was the ability to be accompanied by ECAs from the EPC contractors. And so the response has been very good. I believe the debt is going to be coming forward. and we are in advanced discussions on that. With respect to the equity component, there again, we have significant appetite in terms of consumers. We have strategic players who are also at the table, and we have investment funds who have indicated interest to provide the significant amounts that are required to fund this project going forward. So all the pieces of the puzzle on the funding side are identified, and certainly the next 12 months is what we will be doing is bringing the project to financial close.
And what capital expenditure will be required, and what is the level of OPEX that you're anticipating?
600,000 tons per annum production is about $550 million, which is what the studies have shown. Obviously, as we progress, we will optimize that, and that includes cost of financing. So these are capital-intensive projects. However, given the specific advantages of the project, we sit there again on I would say, an advantageous position in terms of the capex per ton for this project. In terms of OPEX, we estimate that we will be in mid to late 60s, $65 to $66 per ton, which again positions us in a very competitive way.
And could you give us a glimpse of the current state of the potash market?
So the potash market is, I would say that it's in a situation that has been severely impacted by the current geopolitics. These geopolitics have more or less taken out about 40% of the production, which traditionally comes from Russia, Belarus, and various other players. It has also put a bit of a curveball. The geopolitics have put a curveball in the market as gas prices have skyrocketed, and gas is used in the production of MOP. So all in all, we've had serious upward price pressure on potash. So we've had prices in excess of $1,000 per ton, which is something that hasn't been seen in an extremely long time. Prices have come down again to around 800 and some odd dollars per ton. We believe that this is an anomaly and that it will normalize somewhat, but we are still going to see robust prices going into the future. As you well know, the entire planet is now very focused on food security, which is a major concern for most parts of the world, if not all parts of the world. And of course, the deglobalization of the planet has also meant that there's a race which is on to secure source of raw material, which goes beyond financial returns. It's almost an existential debate, and fertilizers is part of that debate. So all in all, for the fertilizer market, the whole paradigm, I think, is shifting in the same way that our world paradigm is shifting.
And when it comes to offtake, have you signed any offtake agreements? Have these been made?
So we have two LOIs, strong LOIs from very strong parties, backed with all the financial wherewithal that we would require. And we have a number of majors who have confirmed interest in entering into offtake agreements. Offtake agreements are probably one of the most important part of any project, specifically when you're looking at raising project finance. So no, we have not entered into offtake agreements quite purposely. We want to retain the flexibility, the latitude to negotiate offtake agreements that will support the financing without capping the possibility of returns. So we don't see any issues in securing offtake agreements, but we are not rushing to enter into those agreements.
And what, in your view, should be the biggest takeaway from this interview?
I would say that the biggest takeaway is that there is a new player in town. We've been very focused on executing, and we are extremely well positioned to tap into the Brazilian market, which is one of the two largest MOP import markets in the world. And probably more significantly, we are uniquely positioned to service the African market. And Africa is coming into its own, specifically agriculture is a key focal area for Africa. And we expect huge growth in agriculture, strong demand for fertilizers, and we are extremely well positioned.
That was Creamer Media's Mining Weekly, speaking to Stefan Rigney, the executive chairperson of Kanga Potash.